Ladies and gentlemen, thanks so much for tuning into The Scoop. I'm your host, Frank Chaparro, Director of Special Projects at The Block, and we have a very exciting episode of the show for you today. Continuing, I feel like, what has been one of the most interesting trends in two parts, right? We're going to be talking to someone who knows a thing or two about stablecoins, but also we have a new entrepreneur. And I feel like if you think about what 2024 was for the show, it was bringing on, well, he's not a new face in some respects, but new builders in this market, which is so important. And we love that. We love that added expertise and that fresh perspective. So without further ado, we have on the other side of the mic, Nick van Eck of Agora joining us. If you don't know them, if you missed their April news, feels like years ago, but it's only been this past spring. They raised $12 million in funding in a round led by Dragonfly to enter the competitive realm of stablecoins. Sir, you made the switch. You made the switch from VC to starting your own company. How have these last few months been for you guys?
They've been great. I think we've made a tremendous amount of progress in a very short amount of time. As you hinted at, I spent my entire prior career investing in technology companies. And it's been great to focus on one thing for the first time in my career. And one of the things I really loved about investing and working with many founders is that there's a lot of intellectual stimulation and curiosity required because you're working with folks. They're solving different problems in different markets, and so you are constantly educating yourself on new things. But for the first time in my career, I'm focused on one thing, which is building the most liquid digital dollar globally. And things have been going extremely well. We launched in limited availability 2 weeks ago on ETH mainnet and are already at 40 million in AUM, TVL, however you want to characterize it, and have a lot of exciting things coming down the pipe.
I think for many listeners, the first question they might want to ask someone who's building in this category, it's red hot for a reason, right? You can make a lot of money. How do you build those network effects that are so important for a stablecoin? Building that sort of robust ecosystem, right? If you think about something like Tether, that was really built on the backs of, large, high-speed traders wanting to move in and out of crypto. You think about what it was for Circle, right? Maybe it was that DeFi summer Cambrian explosion. What is it for you and Agora?
Yeah, I think, they're very profitable at scale. If you don't really hit that 0 to 1, it's really tough to be a very small issuer. I think for us, we're entering a phase of completely new market structure and dynamics, right? And you previewed this a little bit, but if we look at the first era of stablecoins, that was Tether. They were the original visionaries, brought dollars on chain, enabled instant settlement and cross-border money movement. Tether obviously being owned and affiliated with Bitfinex. Then we had this second wave of stablecoins that took off last cycle. Those were primarily exchange-backed stablecoins. And if we think about when USDC launched in 2018, BUSD, GUSD, all took off around the same time. Really, the main things that folks were using them for were trading on exchanges as quote tokens and collateral. DeFi Summer was instrumental to USDC's, I think, initial takeoff last cycle. They really became the centralized institutional stable between them and Tether. BUSD also had a lot of success, but was then knocked off by regulators. And so we're now entering this world in 2024 where the market structure looks very different. Right? Think about what's happened since 2018. You had this explosion of DeFi. You have multiple chains, VMs coming to market, regional exchanges globally. Custodians like Fireblocks, Anchorage have really come onto the scene. And you have many different stakeholders, right? I would say the market for crypto is much larger and is also starting to eat traditional businesses. And I was sitting in my seat last year, and I was thinking about, where are we going, right? Ultimately, I believe stablecoins are going to eat the euro dollar market, and that's going to be a 15, $20 trillion market. So euro dollars are US dollar deposits, outside of the US banking system. So sitting in offshore banks or accounts. And we think stablecoins are 10x to 100x better because they enable instant settlement, which is great for cross-border payments, moving money, but also expanding financial freedom. And as we look at this sort of new era and structure that we live in, USDC and these exchange-backed stables are rife with conflict of interest, because ultimately they're accruing value and rent seeking, from our perspective, from people that are driving utility and liquidity to them. And so if you look at the market today, Coinbase, which is USDC's primary partner and who Circle started USDC with, is competing with exchanges, with custodians, with prime brokers. They're now competing with chains, wallets, and they're really trying to eat the whole stack. And so if you have USDC sitting in MetaMask or on a different exchange or in Fireblocks, right, or on Solana, a large portion of those unit economics are actually going to Coinbase, which is competing with many of these providers.
You're bringing up or highlighting something that, I haven't heard before. I know you're having all these conversations with your peers and competitors, which is they are intertwined with folks that there might be some conflict here, right? In as much as, Coinbase, right, has this vested interest in USDC, but they're also an exchange, a prime broker, all these different things.
Yeah, that's like one of them. But it's also fundamentally, we believe that money should be neutral, right? There shouldn't be conflict of interest. I also think what people tried to address about a year ago is as rates rose, right, a lot of attention came to how much money Tether and Circle were making, right? And I think some folks' first approach was, okay, let's launch centralized yield-bearing stablecoins. There's a lot of issues at the product level with those types of products, right? It's because once you become natively yield-bearing, you're clearly a security product. And so Paxos announced USDL, their yield-bearing stablecoin, about a month ago now. And they said, hey, if you're an American, Canadian, UK, EU, Hong Kong, Singapore, and Japanese person or entity, you can't touch this. That's 60-70% of global capital markets. So not only are you depriving yourself of the ceiling of utility, but you also reduce the addressable market. And ultimately, stablecoins should have extremely high utility, flexibility, and liquidity. Another issue with these yield-bearing stablecoin products is if you are paying, if you're interacting with the banking system and paying individuals or entities without KYCing them, you could run into regulatory issues. And lastly, they have no margin. They make 10 to 15 basis points. Circle and Tether fund liquidity programs, right, which are extremely expensive. That's why if you want to swap in and out of USDC, USDT, you can do so without much slippage on many markets. And that's really expensive. And stablecoin providers need to fund that. And our view was, so that was a bad product. So what does a good product look like? One, it's a one-to-one stable, but we're actually sharing economics with businesses, because our view is it's the businesses that drive utility and liquidity to these assets. If Bybit didn't list USDC, if Anchorage and custodians didn't accept USDC, USDT, these assets would have no value, right? Because they would have no utility. And so what we're doing is we're going to exchanges, fintechs, applications, and saying, hey, if you provide services to us, whether that's marketing, listing, etc., we'll share 50, 60, 70, 80% of the net revenue with you, right? They KYB with us, and then we're giving cash flow to that business owner, right? And that's really resonated with people.
So it's sort of like it's kind of trying to take the USDC model, but diversify, right? So it's not just Coinbase, but whomever is facilitating the growth of it is then participating in the economics.
Exactly.
In your view, you're not running amok with regulators because it's not being kicked back to the end user who may be retail. It's a business agreement.
Exactly. There are business agreements for commercial services that they provide to us, and we KYB those businesses. And then it's up to the business what they want to do with it. right? They could increase their security budget, pass it through to their own users, hire more people on their team. It's totally up to them. And that's also part of the beauty of it is it works across all business models because we're saying, hey, you don't need to change how your business runs. Just use the stablecoin that is best for your business and ultimately your users, right? Because as the business owner, you're now getting a new cash flow stream that you can choose to do with what is best for your business. And we ultimately leave it up to them. Like they're running their business. They know it's best for them. And so that's resonated with a lot of people, across all aspects of the market, in addition to folks that no longer want to have, be utilizing an asset that is in many ways a conflict of interest.
Going back to sort of the market structure changes that you were sort of describing, you very eloquently broke down this sort of like evolution over the past 6 or 7 some odd years. But underpinning that, or sort of maybe preceding that was, right, like this change in what collateral is in crypto. Pre-Tether, maybe, right? Collateral trading pairs were denominated in Bitcoin, right?
Yeah. I remember those days.
You guys were really early back then. And then we transitioned, right, to Tether and to USDC. And now we saw recently Athena, right, as I don't know if it was collateral or as a trading pair on Bybit or one exchange. But then on the I guess, and we can get into the nomenclature of some of these things as you see them.
Yeah.
Just really quick to round it out. You also have what can we call them? Tokenized money market funds or tokenized treasury bills being accepted as collateral by like a Falcon X and such with BIDL. So there's all of these changes, and you're seeing like this Cambrian explosion of similar looking products. How would you maybe add to that storyline that I drew out, and how would you describe what the current situation looks like?
Yeah, I think there isn't enough of this in public discourse.
That's why we have this show.
Yeah, this is great. I think the way that I think about us in AUSD is we really just compete with USDC, USDT. We're centralized stables that are one-to-one. And ultimately, we're Lego blocks. Like we are digital cash, so we can be used in many different products, but also have like the largest, I think, market because of that. You mentioned Athena. That was a really innovative product that the guy and the team came up with. Ultimately, right, we view them actually as customers or partners of ours because they need to have liquid assets to help them either maintain the peg or in their treasury or insurance fund. And those for them are ideally on-chain liquid assets, right? And so we can work directly with someone like Athena. One of my co-founders, Drake, was the lead dev at Frax. The Frax team are going to be great customers and partners of ours because ultimately their decentralized product is backed by other products like USDC or USDE in their case as well. And so they're actually consumers of our product. Right. And so it's really, AUSD, USDC, USDT are competing with one another. And then what you can do is sort of move to the decentralized stable side. Right. Obviously, Athena is doing the basis trade. Then you have other companies like Usual, which are wrapping centralized assets like us. Right. So again, they can be consumers of our product. And so we view decentralized products as actually customers and channels of ours. Right. And I think folks don't differentiate on that enough either. But then maybe let's focus on sort of the differences between one another. Right. So you could have a product, right, where they're saying, hey, we're only going to wrap treasury funds on chain. Right. That's probably like I would say, let's say that's a AAA or an A grade product. And then someone may say, hey, we're going to incorporate riskier assets as well. Okay, well, maybe that's like a B graded product on the risk curve, right? And then you have something that's saying, hey, we're going to offer you 50% APY and there's a lot more risk, right? That's even further out, right? And probably a lower a section of the market. So the way that I like to frame it is like AUSD, USDT, USDC are like digital cash, like your checking account, right? You can kind of use it in anywhere. It's the highest utility asset. And then as you start to go down the road with these other products, it's very similar to like the fixed income market, right? You have like AAA corporates, Bs, and then you have like junk bonds, right? And I think folks should think of it similarly, right? If you're getting a higher yield, there's probably higher risk, right? And ultimately, it's a fundamentally different product. And so they may be customers of ours or channel partners of ours, but they're not really competing for the same user as us, right? Maybe just to talk about Ethena a little bit, they've built a great product for traders, and now they're being used as collateral, right? Their primary customer that they're going after is probably trading firms, right? Who are comfortable taking the risk, who really deeply understand the product, and we're like, this is an additional source of alpha for them to be using, right? They're probably not going after someone in an emerging market country that just wants to save dollars to protect their wealth, right? So I think different customer segments, different markets, in some cases, they're actually really great customers and partners of ours. But ultimately, this is a very big market with different consumer profiles.
So how do you think about, we'll drag you into this debate that I got stewing between Caldura of Ostium Labs and Carlos Domingo of Securitize, right, over this word of tokenization and the extent to which we may or may not need to get rid of it. It looks like they're going to have some sort of a cage fight of sorts, but what do you make of that word, and do you think it's needs to be altered or improved? Because at the end of the day, one thing, and I think we've talked about this before, even off screen, is like it feels like when RWAs became a big thing, it's like, well, that's just what stablecoins are, right? Stablecoins are literally just, they're the biggest RWA.
So I don't know exactly what they're arguing over, but I could maybe have a guess. I think there's a few different ways to bring assets that are not on-chain, right? One way is through perpetuals. The other is actually just having the canonical, the asset, canonically on-chain, right? Ultimately, I think, again, it's like sort of like different markets, right? Maybe some things are more used in perpetual markets, but I think the vast majority of products will be tokenized and put on chain. But it's going to take us a while to get there. And I think we're at least 3 to 5 years away from things inflecting on the asset tokenization side outside of stablecoins. And the reason for that is because we don't really have the structure for that to take off yet. Instant settlement, lower transaction cost, composability is great for financial services, right? But for BUIDL to be 10x better, or an on-chain treasury fund to be 10x better than the status quo, all of the incumbent financial service providers need to be able to interact with that asset, right? Because today, tokenized treasury funds, the only people really consuming them are folks that are deep into crypto, right? Or are comfortable interacting with the space. And so you deprive yourself of a lot of liquidity and utility. But once NASDAQ, BNY Mellon, State Street, like the traditional custodians, banks, exchanges, prime brokers, are able to interact with these assets in a way that's similar to how they interact with traditional securities or assets, that's when you're going to really see this explosion take off, because then those assets become 10x better.
That is the most important and humorous point to make, because I've asked on this show countless times, like, why is it better right now? Because it doesn't seem,
it's not better now.
It's not. Because
it's very much not.
It's still siloed out, right? Until everything's end to end on chain. It's really just a play at the fees and the marketing.
I would agree. I think it will be 10x better, but we're certainly not there yet. And you need the traditional players to start accepting and interacting with crypto. So I think people like Fireblocks and others who are making crypto more usable for traditional financial service institutions and comfortable are doing the Lord's work. I also think having clear regulation in the United States will help this move so much faster. And And if banks and payments and financial service companies feel comfortable that they can interact with these assets in a sandbox environment, I think that's when you really start to see these things take off. And it will be 10x better, but we're not there yet.
How would you explain to listeners exactly how it makes things better? How does it improve capital markets?
I'll give you a great real world anecdote. Okay, a few years ago, it was tax season. I needed to pay my taxes, and I was like, okay, like I'll just sell some of the equities I have in my Fidelity account. So I did, and then I remembered, I have to wait for it to settle 3 days before I can actually withdraw that cash to my bank account to pay my taxes, right? And so instant settlement enables much greater capital efficiency. You don't have to pre-fund accounts. It gets rid of factoring. So like that in and of itself is massive innovation, right? It's why I think folks got a lot of trading firms leaned into Tether at the beginning. Is because now they could really actually move money like globally 24/7. And so that's certainly part of it. I think composability is really interesting. But it's really instant settlement, lower transaction costs, and enabling programmatic transactions. I'm less familiar with this, but I know a lot of people are excited about being able to like incorporate data into assets, right? So getting rid of like a lot of manual paperwork that is traditionally done in like subscription processes, like you can sort of bake in into the token. I'm not as familiar with how that works technically, but I know some friends are excited about it. So that's another aspect as well that I think is exciting to folks.
When you think about the future, right? Like it's there's probably, some broader vision, right, than just the sort of flagship product. What else can you build on top of this thing that you've got cooking?
Yeah, so for us, ultimately, it's first building the most liquid digital dollar. And then beyond that, I think there's a lot of interesting things that we can do on the transaction side of the house. And I don't want to give too much away, but I think you could imagine us, right, as the issuer, you're a native on and off ramp. And also the lowest cost on and off ramp. And so what we want to do is ultimately become the business for moving money globally. Whether you're Pepsi or a crypto company. And so we're going to be building a lot of infrastructure and tools that enable that going forward. And ultimately, we want to lower our transaction costs and bring transaction costs 10x down 90% and increase, I would say, the value 10x. Something that's a little bit of a far-flung idea that we have is hopefully when we get big enough, we can go direct to merchants and say, hey, you remember the 3% fees that you pay to card issuers like payment companies like Visa and MasterCard? Just accept AUSD, you'll get the money instantly in your merchant account, and it'll be 25 bips or 50 bips. We're not nearly the scale that we need to be to start getting merchants to move. That's definitely like a 5 to 10 year goal for us. But there's a lot of different things that you can do when you really own the money layer that I think are attractive and make things cheaper for businesses and individuals.
Which is harder? Which market's harder to go after, that merchant business, that merchant category?
Yeah, I mean, you effectively have like a duopoly cartel, very similar to Tether and Circle today, right? And so we want to break that, starting with crypto and digital dollars, and have value accrue to the stakeholders that we believe are really driving it, which are businesses and their users, versus being a rent seeker. But it's a step-by-step process. Things obviously get bigger as you have greater utility and liquidity in your stablecoin asset, but there's a lot of things down the road and products that we'll be launching next year that are different.
What's your sort of the perspective coming from a venture fund and building a specific product like this?
Yeah, I would say my experience in investing and working with founders my whole career has helped me have a good understanding of what exceptional looks like and best in class. Across many different facets of the business. I sort of view like having worked in ventures, like getting your PhD in startups. And what's been really helpful for me is like the network I've built of founders that have been super, super helpful as we've gotten this business going, in providing advice, using us at our early stages and being early supporters. And that's been a tremendous advantage. For me, I would also say being on the venture side, you get the time to really deeply dissect markets and strategies that is a little bit tougher when you're in the weeds of operations 16, 18 hours a day. And so when I was starting the business, I really pressure tested our thesis and thought deeply about our competitors and sort of what might happen 3 to 10 years down the line than maybe first-time founders typically think about. And so it's been super, I would say, helpful to us as we've gotten going.
And how does that maybe impact your view of like success in the short to medium term? What KPIs and metrics? I imagine you might be looking at it through the lens as if you had invested in it yourself.
Yeah.
What you'd be looking for in a portfolio company to hit over X period of time.
Yeah, we have a very high bar. Ultimately, we want to win this market and be the dominant global stable. For us, we just got going 2 weeks ago. We're a 10-month, not even 10-month-old company yet. Have about 40 million in AUM. So I think we're off to a good start, but it's really just the starting line. And so for us, it's focusing on building liquidity on these networks, adding networks, and growing AUM. I think there's an opportunity for us to win a lot of the newer high throughput, low latency chains that are coming to market, as well as being a better service provider to many of these market participants that we talked about earlier that have been cut out, right? And may want to be working with a neutral party on the stablecoin side, given stables are so core to everyone's business.
They're very important. It's one of the hot trends of the year. Sir, thanks so much for joining the program.
Yeah, thank you.
We'll have to have you back on soon.